Let's Talk Money.
Hello and welcome to Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. Well, buying your dream home is perhaps one of the biggest decisions that you take with respect to managing your money and your finances. Now, whether it's buying a house or it's selling a house or it's investing in a house property, these are all big decisions, and they require careful tax planning and tax considerations as well. And that's exactly what we're going to focus on the show today. I have with me someone who's a big expert in these matters when it comes to property and taxation. Harsh Rungta, founder of Fee Only Investment Advisors, is here with me in the studios to throw some light on this rather complex subject. So, Harsh, thank you so much for joining in. And, I'm already bracing myself for all the different tax sections that we have to be aware of: selling, buying, renting a property. But the floor is open. So you start with what is the thought process with which we should approach property, whether it's for self-use or for investment.
So I think one thing is that there is far too much emphasis given to tax while looking at a property purchase or a sale. It is like any other asset buy or a sell. Tax is a consequence. You first do a calculation whether it makes sense to buy a property or it makes sense to sell a property. Okay. All that tax does typically on selling is that it will reduce the value of what you sell. It will effectively reduce your selling price, and maybe you can do something to sort of not have that reduction. Whether it is worthwhile or not, you've got to figure out. But the short point is, I think too much emphasis on tax or doing a purchase or a sale based on tax, I think is unwarranted.
Fair enough, but I suppose, once your other larger sort of issues have been sorted as to why you're doing a sale or purchase, that's when it's important to do your tax math, right? To make sure that you've completely covered yourself over there. So, Mr. Rungta, we want to take it step by step. We also have lots of your questions that have come in on this issue. Let's start by understanding the decision to purchase a house. Once that decision has been made and once you've figured out that yes, you're going to take a home loan or you have some capital set aside for it, or maybe you're going to sell other assets and then deploy that money to purchase a home, how should one go about the structuring, the whole sort of getting the financial math right as you're looking at this big ticket item?
So, like everything else, the decision to purchase precedes how you will finance. Now, the decision to purchase can be divided into two parts. First, you're buying something to stay in it. Second, you buying something to invest, and I think the considerations are completely different. When you are buying something to stay, what is really important is the locality,
Yes.
Affordability. Can you really afford?
Yeah.
Versus you may want to stay in a certain locality, but you may not be able to afford buying in that locality. So maybe you are better off renting in that locality.
Yeah.
So the buy versus rent, subject to a certain locality, right, is a very important decision when you are buying it for staying, right. Then comes, if affordability is there, that takes into account that you will have the money for the down payment, you will have the money for paying off the EMI, there will be income enough to pay the EMI if at all. You may also decide not to take a loan. Okay. So, my point is that is the consideration, where locality is the big consideration. Sure. Moment you are talking property, I think locality goes out of the window basically, except as one more parameter to see whether that will give a return kicker, etc. Another example of what may not be important is in an investment property, I can't understand why anybody would buy under construction, because that's a huge additional risk. You are not buying real estate, you are buying a builder's promise. Okay. Whereas when you are buying for home, you may decide to buy under construction simply because they give you the amenities that you are looking forward to in the locality in which you are. wanting to buy, their only under construction might be there.
Yeah.
So you may decide to take that risk.
Right.
So you see that the parameters are completely different.
Absolutely.
And you will also notice I never mentioned tax at all.
I realize that till now, yes. But having said that, now what we want to do is start by understanding some of the very basic fundamental concepts. If you are either looking at becoming a homeowner or are a homeowner, one is income from house property, this concept and how it's sort of, defined in tax parlance. And the other is this concept of loss from house property. A lot of people are thinking already about a loss from house property and how then they can be very smart with tax saving, etc. So let's again go back to the basics.
So like everything else in tax, it's complicated. So I will try and make it a little simple. First, it needs to be divided up between property where you stay yourself. When I say you, it can be you, family, anybody else, versus the properties that you have let out. For properties that you stay yourself, there is no question of a rent. Okay, you getting any rent. So therefore, you are allowed to minus from the, and that's always going to be a loss.
Yeah.
So that's called self-occupied property.
Right.
From there, you are allowed to minus, you are allowed to claim a loss
Yeah.
up to 2 lakh rupees in respect of interest paid on a loan taken to acquire that property.
So the reason it's called a loss from house property is because the annual value of that house, it's deemed to be, I think, 0, right, in this particular case.
Correct.
And then you are paying interest on that house, interest on the home loan,
Correct.
which you can claim as a deduction.
Correct.
So since you are paying an interest, you're paying off a loan, there will be a loss from that
There
particular
will be a loss
house property.
subject to that 2 lakhs simply because that is the maximum that is allowed to be deducted. To complicate it further, that deduction is allowed only under the old regime. It's
Yes,
not
it's not there
allowed
in the new regime. Important. Okay, so what all can you do with this loss? Now, I bought a home loan under the old tax regime. I'm, getting my 2 lakh rupees of deduction on the interest, 1.5 lakh rupees of deduction on the principal under Section 80C. Now, I have loss from this house property in which I'm staying. What can I do with the loss?
You can adjust it against your salary, you can adjust it against your business income, income from all other heads of income.
But up to
Your
what levels?
2 lakhs, maximum
In
of
a
2
year.
lakhs. In self-occupied property, the loss cannot be higher than 2 lakhs.
Okay.
Because the maximum allowed deduction itself is 2 lakhs. So the loss cannot be more than 2 lakhs.
Okay. Okay.
Now, so I'll come to the second leg.
Right.
In the second leg, where we are talking of let out properties, properties on which you're getting rent. There, of course, the rent is taxable. From the rent, you minus the municipal taxes paid for the property. Whatever is the resultant figure, that's called annual value. 30% of that is allowed as a standard deduction
Right.
for all expenses incurred to manage the property, etc.
And this is a house that you've let out.
This is
You're
for a house
you're getting
that you have let
rental
out.
income from that
Absolutely.
house. Okay.
Then you are allowed to claim without any limit any interest you might have paid on a loan taken to acquire such a property.
Okay.
And this is under both the new tax regime as well as the old tax regime.
Okay.
Now in India, what happens is the rental is roughly 2-3%
Correct.
of the value.
Correct.
So let's say 2% net of municipal taxes. If you have taken a 70-80% loan, on that if you are paying 8%,
Yeah.
that's like 6.5%. So invariably this will result in a loss.
Even on a rental
Even
income,
on a rental
you will have a
income,
loss.
you'll
on that
have a
house
loss.
property.
At least till the
Yeah.
loan is there.
Yeah.
Right?
Yeah. Yeah.
Now that loss, again up to a max of 2 lakhs,
Okay.
you are allowed to adjust it against salary, business income, etc. Balance loss, you can carry it forward
For 8 years?
for 8 years.
For 8 years. Okay, Mr. Rungta, I want you to help us out with an example here in terms of capital gains that arise when you're selling a house, either a house that you stay in or a house that you've let out, and whether those capital gains should be reinvested in another property to save on paying that capital gains tax. So if you could give us an example.
So let me use this example to create a framework on how people should think about this, right? Let's say the property you sell at 1 crore, net of brokerage, everything. Let's say you had bought it at 30, but because of indexing, it becomes 70 lakhs.
Bought it many years ago, 30
Many years
lakhs.
ago at
There's
30
capital
lakhs.
appreciation. indexing,
it becomes 70 lakhs becomes the cost, indexed cost of acquisition. Now your net capital gains is 30 lakhs. It's more than 2 years that you have the property, therefore this will be taxed at the normal long term capital gains tax, which is 20%.
Okay.
So on 30 lakhs, the long term capital gains tax is say 6 lakhs.
Correct.
We'll ignore surcharges and cess for the minute, right? Now, so
I'm selling a property for 1 crore rupees. The tax I have to pay, capital gains tax, is 6 lakhs.
6
okay.
lakhs, right? Now the decision for you to take, obviously whatever you do with the 70 lakhs is up to you to do. The choice is in 30 lakhs. For that 30 lakhs, you could either invest it in a capital gain bond, right, which allows complete exemption. That will pay 5.25 taxable interest. That's one option, number one. You can buy a property of 30 lakhs, okay, and hold that property for 3 years, post which this will, so the capital gains is not payable. Or third option, which very few people consider, is pay the 6 lakhs and invest the 24 lakhs. Because end of the day, this is an investment decision, which is what I want to tell people.
So you say 24 lakhs because looking at the indexed cost of that house at 70, the gain is actually 30 lakhs.
Yes.
And out of that, you can just pay 6 lakhs as tax and invest,
invest the
rest.
balance 94 lakhs. Now, the issue is capital gain bond scheme is still okay. Because you just pay 30, it's a financial asset, fine. There is no handling required. It gives you a certain yield. Net of tax, say the yield is 4. After 5.25, let's say 1.25% tax. So let's say 4% net of tax yield. At the end of 5 years, you get back the money, and then you can do with it what you want. So you are just taking the punishment of investing in a very safe instrument for 5 years.
Correct.
It's locked in for 5 years.
Correct.
The second instance of buying property, and I'll tell you why that is not so great, I'm not a great fan of that, is one, you will not get a property of 30 lakhs.
You will have to go to some tier 2, tier 3, tier 4.
Maybe, or you will buy a property which if you go, how will you manage that property?
And what is the appreciation? What is the rent you will get on it?
Correct. So if you have to again invest back 50, 60, 70, 1 crore, or be involved with that property, give it out on rent, keep it locked, deal with the society. I mean, this is not something that people, so there is this blind thing is somehow I must not pay tax. All that I want to do using this show as a medium is please consider the third alternative. Pay the 6 lakhs tax.
No, I think you've made a very strong case for it, and with that example, it's very, very clear as to why you perhaps are better off just paying that long-term capital gains tax and using the rest of the money much more judiciously, investing it in a wiser manner. Need to take a very quick break, but we have lots of viewer queries on the other side, so we'll quickly come back and start answering them.
Let's talk money.